Okay, so that's the both of you coming in for you. But street watches what will be RBI's next move. That's going to be the big move this week. Subhana Sheikh caught up with Alka Anbarasu of Moody's ratings on and Karthik Srinivasan as well of ICRA to understand the implications of rate cuts on the banking space and more. Listen in.
On back of perhaps inflation also coming down, we do see that RBI has room to cut rates, and we do expect interest rates to gradually decline in India. Having said that, actually externally, we also see many regulators in Asia Pacific have started reducing domestic interest rates, while globally there are still some uncertainties. But for India, we do see that there will be some room for rate cuts in this year.
But in terms of NIMs, clearly there's going to be pressure on NIMs for banks, because as per our estimates, over half of the bank's portfolio is linked to external benchmarks where the repricing would be faster. MCLRs do not get repriced so fast, but at least on half of your book, the repricing could be faster. Deposit rates are still at elevated levels, notwithstanding that we have seen some large banks cut savings rates or definitely cut on the term deposit rates over the last month and a half. But small saving rates are still high, so it's going to be difficult for banks to cut rates very aggressively unless they really take a call that they want to protect their margins. So we do expect some compression in NIMs over a period of year, maybe 10-15 basis points for the whole year. But a falling interest rate also provides a lot of opportunity for banks to build up on their treasury gains during the current year. So now if I was to just extend your question, NIMs, treasury profits are one aspect. Look at the final bottom line, which is the profitability. There will be some marginal impact, but the overall profitability numbers should still remain fairly robust for the banking sector. Above 1% is our estimates for now.
All right, we are 4 minutes away from market close.